He joins us to check in on his predictions. And Byron, I got to say, looking through the list from the end of last year, beginning of this year, a lot of them are so spot on. I have to guess you've made a lot of money. For example, you said energy stocks will be among the best performers. And if I look at the breakdown of the S&P 500, they are far and away the best performers. Do you think they still have room to run?
I do. I think the price of oil is going to head higher for the right reasons. The economy is recovering. Business is doing extremely well. People are returning back to normal. They're going to be traveling over the summer, and the demand for gasoline is going to increase.
You did also say that you thought by Memorial Day we'd get back to some form of normal with the success of vaccines. Pent-up demand would drive depressed hospitality and airline stocks. We've seen that, of course, happening now. And you thought we'd see nominal growth of more than 6% this year. How is inflation coming along with those forecasts?
Well, I know there are a lot of people who side with the Federal Reserve and say inflation is transitory, but that's not my opinion. I think there are a lot of inflationary pressures out there. The fact that chips can't unload, the fact that workers are harder to find, the fact that housing is booming, all of those things indicate to me that the 10 years at some point this year is going to go above 2% in yield, and inflation is increasing. I think that's one of the negatives in the outlook. On the other hand, I don't think inflation is going to go above 3%. I think it'll be between 2 and 3, and I think the market can deal with that.
It's interesting because Bill Dudley yesterday wrote a Bloomberg opinion piece for us, and he said, look, the Fed is too focused on full employment and allowing the economy to run hot, and that means they're going to have to turn around at some point and raise rates faster than they normally would to slow things down. The concern is that we then go into another full-blown recession. But one of your predictions was that we are beginning now the longest economic cycle in history. You think it's going to surpass the one that lasted from 2010 to 2020. Do you stick with that, even with your views on inflation and the possibility that the Fed is going to have to slam on the brakes?
I don't think inflation is going to get so high that the Fed has to really be tough. I think the Fed will raise rates or, stop accommodating, but I think the economy can still move ahead. So I don't know if we'll go the full decade with increasing growth, but I do think we'll go the next few years without growth getting to the point where the Fed has to take definitive action.
What does this all do to gold? It's a commodity I've been watching very closely this year. It's one of those predictions that you made again. You said gold is going to have a strong 2021. Indeed, we've gone from 1,700 to almost 1,900 now. Do you think gold has further to run, especially as Bitcoin has usurped some of its inflation hedging prowess?
Yeah, I'm not a big fan of Bitcoin at this point. I've been studying it. I wonder if it's a geriatric thing that I can't bring myself to buy it. But I think gold will do better because inflation is going to be more of a problem, and people will look at gold as a hedge against it.
You did say that you thought cryptocurrencies would gain more respect, Byron, and even though we've seen this roller coaster ride with Bitcoin, at one point it was at 65,000. We just showed it now down to 32,000. Does that then seem like the end for you? I mean, do you think, the curtain has been pulled aside, or are Wall Street heavyweights going to increasingly lend their reputations to Bitcoin, back Bitcoin, and make it an investable asset?
Well, the reason that I can't bring myself to buy it is that it is just a trading vehicle. When I use something like Bitcoin, I use it as the equivalent of cash or a safe place to put reserves. And I don't want to put it in anything that volatile. It is a trading vehicle, and if I wanted to trade something, I'd want to trade something where I could have an opinion about the earnings outlook and the prospects of the price of the stock and that sort of thing. So I trade in stocks, but I put my reserves in things like gold, and Bitcoin isn't like gold.
All right, so you mentioned earnings. You also forecast that the S&P would trade at 4,500 later this year. We've seen this reopening rally push the gains from the bottom in 2020 continually higher and higher and higher, right now trading at 4,230. Are you still looking for 4,500? Could we see even more this year?
Well, 4,500 was a pretty ambitious forecast at the time I made it at the beginning of the year. And I don't revise those targets during the year, regardless of whether they make me look good or bad. So I'm sticking with the 4,500. I feel pretty confident about that, but I'm not willing to say that I have a lot of conviction that it's going to go well above that.
Well, it certainly looks like it's headed there, although you're right, it's very bullish. We're already up 12, 13% year to date, and another 300 points, another 270 points would be pretty impressive. A lot of it, of course, has to do with the dollar, Byron, and everybody was calling for a continued drop in the U.S. dollar. If you look at the Bloomberg Dollar Index, we've seen it come down, but really bounce over the last couple of trading sessions. Right now we're at 11.18. Does the dollar come back, or was the peak that we saw at the end of March the high point for the greenback?
Well, as the economy recovers, assets in the United States, real estate, stocks are attractive. I thought more money, and we know capital spending is increasing. So I think foreigners are going to be more comfortable putting money in the United States. And as a result, I was bullish on the dollar. I have to admit, as you suggest, that the fact that everybody was bearish on the dollar at the beginning of the year raised the issue of maybe it's not going to do as badly as everybody thinks. And it hasn't done as badly as everybody thought. And I think it can have a positive year. And I still believe that.
It definitely was a crowded trade, and it's turned around a little bit. We'll be watching that closely. A lot of it has to do with all of the fiscal stimulus, really unprecedented money being poured into the economy by the U.S. government. What are your thoughts on how much more we get? President Biden has proposed another, $4 trillion in spending in total that still needs to go through Congress.
Thank God for Congress, because I thought the $4 trillion on top of $4 trillion that's already out there, $2 trillion in the middle of last year to deal with the recession, $2 trillion in the American Rescue Plan. So my feeling is if the full $4 trillion from the American Jobs Plan, the American Families Plan, if that were to get into the economy, that would be too much fiscal stimulus, and it would create a serious inflation problem. I think both the jobs and the families program will be trimmed back. And as a result of that, the economy won't overheat. It'll get stronger. Inflation and interest rates will move higher, but they'll remain somewhat restrained. And that's a favorable background for the equity market. So I think that the fact that Biden isn't going to get all of his program through is good news rather than bad news.